Welcome to the Opening Bell Report.
Okay, let's just start with the number. 107.4 million. I mean, on a spreadsheet, it's just digits, right? It doesn't look like much.
Until it's not just digits. Until it's a weapon.
Exactly. Or a target. And that's what we're talking about today with BigBear.ai, ticker BBAI. That 107 million figure, that's the number of shares currently sold short.
And you know what happens when a number like that gets out?
Oh, yeah. The internet just goes into a frenzy. Every forum, every chat is asking the same question. Is this the next GameStop?
It's the ghost of 2021. It just haunts the market. Anytime you see high short interest, that's where people's minds go.
Yeah.
They're looking for that squeeze.
But look, we're not here to just feed into the hype. We are not financial advisors. What we want to do today is use this really detailed new analysis report on BigBear.ai as like a case study.
A live laboratory.
Yeah. To understand the physics of a potential short squeeze. Because this report argues this is just hype. It's a structural setup. They call it a powder keg.
And that's a really important distinction. Hype is just emotion, right? A powder keg is about mechanics. It's about what the report calls the coil structure in the data.
Okay, so let's unpack those mechanics. That headline number, 107.4 million shares shorted. For someone who maybe doesn't track this stuff every day, why is that number so alarming?
Well, the raw number doesn't tell you the whole story. You have to compare it to the float.
Which is the number of shares that can actually be traded by the public.
Exactly. Not what insiders are holding. And those 107 million shares, that's about 24.79% of the entire float.
Wow. So almost 1 out of every 4 shares available to trade is a bet that the stock is going to zero.
It's a huge bet. And you have to understand the benchmarks in the report. Anything over 10% short interest is considered high.
Okay.
When you get over 20%, you're in what's called extreme territory.
Yeah.
So, yeah, BBAI is deep in the red zone.
And being in the red zone is dangerous for the shorts themselves, not just the company. This is that trap mechanism, right?
It's the forced buying. See, shorting isn't like buying an option where you can just walk away. You've borrowed something. You are legally obligated to give it back.
You have to buy the shares back on the open market. No other way out.
None. And if the price goes down, great, you win. But if the price goes up, you still have to buy back all 107 million of those shares.
Which creates that feedback loop.
The forced buying loop, yeah. The price ticks up, some shorts get margin called, they're forced to buy. That buying pushes the price higher, which forces the next group of shorts to buy.
It's like a chain reaction.
It's the potential energy stored in the system. But, and this is a huge but, a powder keg needs a match. And the people shorting 25% of a company, they're usually pretty smart. They have a reason.
Right, which brings us to the bear case. Because looking at this report, their argument for shorting it is, well, it's pretty solid on the surface.
Oh, it's brutal. If you just look at the income statement, you'd probably short it too. The report points out that revenue is actually shrinking. It's down 20% year over year.
For an AI company, that's a disaster.
It's supposed to be a growth story.
Yeah.
And on top of that, they're just burning through cash. A negative free cash flow of $49 million.
So the short thesis is simple. The company is getting smaller, it's running out of money, and it's headed for bankruptcy.
That's the playbook.
Yeah.
Except Big Bear played a card that seemed to have caught the shorts completely off guard.
The liquidity event.
The liquidity event. They just finished a massive debt restructuring. And the result is that right now, they are sitting on $450 million in cash.
Nearly $500 million for a small cap stock.
It's a fortress. And if you're a short seller who's betting on bankruptcy,
That's your nightmare scenario.
it completely destroys your timeline. Shorting costs you money every single day in borrow fees. You need the company to fail soon. With that much cash, the report estimates they have a runway of like 12 to 24 months. Easy.
So they don't need to dilute shareholders. They don't need to raise money. They can just wait.
They can wait out the shorts. And that turns the trade from a smart bet into a painful trap. You're stuck paying interest on a bet that might not pay off for 2 years, if ever.
And that anxiety, that's the fuel for the squeeze.
That's the fuel.
Okay, so we have the powder keg, we have the fuel. Now we have to talk about the GameStop comparison. The report actually does a head-to-head. Is it fair? Or is it just hype?
It's nuanced. The report basically says, don't call it the next GameStop, but it also kind of says, but it rhymes.
Okay, so let's start with the differences. Why is it not GameStop?
The sheer magnitude of the short interest.
Yeah.
We said BBAI is at 25%. Do you remember what GameStop's was?
It was something impossible, like over 100%.
It was 140%,
Yeah.
a mathematical singularity. There were literally more shares shorted than existed. Shorts could not all get out.
Right. So at 25%, it's dangerous for the shorts, but it's not impossible to escape.
Exactly. The other big difference is the float size. GameStop was a small float, which made it easier for retail traders to kind of corner the market. BBAI is much larger, about 431 million shares.
A much heavier rock to lift.
A much heavier rock. But the report does point out one area where BBAI might have an edge. They call it the narrative premium.
The story.
The story. Think about it. Gamestop was a dying video game store in a mall. The story was nostalgia sticking it to the hedge funds. BigBear.ai is in AI defense.
It sounds like it's straight out of a movie. Cyber warfare intelligence.
It's the two hottest sectors on the planet combined. AI and defense. It is so much easier to sell a fear of missing out story about the future of warfare than about used video games.
So even if the mechanics aren't quite as extreme as GME, the story is maybe more powerful for today's market.
The sector momentum is way stronger. An AI stock can catch fire with algorithms and retail much faster.
Okay, so that brings us to the trigger. What actually lights the fuse? The report gets super specific here with price levels.
Right. This is where it stops being about fundamentals and becomes pure market mechanics. To start a squeeze, you need to force margin calls. You need to hit a pain threshold.
And the report names a number.
It does. $6.50.
Why that number specifically?
It's a major technical resistance level. You can see on the charts in the report, the stock has hit its head against the ceiling right around 640, 641, over and over.
So if it breaks through that.
If it breaks through 650 with a lot of buying volume, it's like a jailbreak. Suddenly, every short who got in when the stock was in the $5 range is officially losing money.
And that's the psychological tripwire.
That's when the panic can set in. Do you hold on and hope, or do you buy to cover your losses?
But it won't just get there on its own. It needs a push, a catalyst.
The report lays out two big ones. First is a major contract win. They work with the U.S. Army, with Cyber Command, a surprise $100 million contract. This could easily be the spark.
And the second catalyst goes back to that pile of cash.
Exactly. The acquisition play. They could use that $450 million to buy a smaller, profitable company.
Which would instantly fix their shrinking revenue problem.
Kills the bear thesis overnight.
Yeah.
And it shows they're on offense, not defense.
The report also mentions a gamma squeeze. Can you just quickly explain how that's different?
Sure. A short squeeze is short sellers buying stock. A gamma squeeze is market makers buying stock.
A big banks?
Right. When retail traders get excited, they buy call options. The market makers who sell them those options need to hedge their position.
By buying the actual stock.
By buying the actual stock. So as the stock price rises towards those option strike prices,
they're forced to buy more and more stock.
Right. So you get this crazy feedback loop of shorts buying to cover and market makers buying to hedge. That's what creates those insane, 50 or 100% moves in a single day.
It sounds like the perfect setup. But we have to be the adults in the room now. Section 5 of the report is called the cold, hard reality.
We do. Because it's easy to get caught up in the trading mechanics and forget there's a real business here. And the report is very blunt. It says the fundamentals are ugly.
They really stood out to me. We know revenue is down, but that cash burn ratio.
It's a rough one. They're losing 24 cents for every single dollar of sales they make.
Let that sink in. For every dollar that comes in the door, $1.24 goes out.
It means the business model right now is fundamentally broken. It's not sustainable.
So that $450 million isn't a war chest, it's life support.
Precisely. And if they don't fix the core business, they will burn through that cash. It might take 2 years, but gravity always wins.
Which means this is a trade, not an investment.
100%. The report warns that if no good news comes, the stock could just slowly bleed back down to $3.50 on those fundamentals alone.
So the report suggests some very strict rules for anyone watching this.
Yeah, it suggests a speculative entry above 580, which would show momentum is building. But, and this is the most important part, a hard stop loss if it drops below $5.
So if it breaks 5, you get out. No emotion.
Don't fall in love with the trade. The setup has failed at that point. Protect your capital.
Okay, so let's wrap this up. After looking at the trap, the fuel, the triggers, the risks, what is the final verdict from the analysis report? Is it the next GameStop?
The conclusion is no, but also yes.
Okay, explain that.
It's not the next GameStop in terms of scale. The math isn't there for a move from $4 to $400. That's just hyperbole.
Right.
But it is a prime candidate for a mini squeeze. The report concludes that a fast, violent rally of 50 to 100% is a very real possibility if one of those catalysts hits.
It's such a weird combination. You have a company with just objectively awful fundamentals.
Terrible.
But it has almost perfect market mechanics for a squeeze.
It's the ultimate battle of value versus flow, and right now we're just waiting to see which side blinks.
It's fascinating.
Reading this, it left me with this one big question about the way markets work now.
What's that?
In a market that's so driven by algorithms and liquidity flows, does the actual health of the underlying business even matter as much anymore? Or is the trap that's been set for the bears the only thing that matters?
We're always taught that the price reflects the business.
Right. But In a case like this, the price isn't reflecting the business, it's reflecting the positioning of the traders. It makes you wonder if betting on a squeeze is just a game of musical chairs, or if identifying these structural flaws is actually the new form of investing.
Are you investing in a company or just betting on a glitch in the system?
Exactly. And if the glitch pays, does anyone care about the difference?
That is a question to think about. All right, that's a wrap on this deep dive. We will definitely be keeping an eye on that 650 level.
Watch the charts.
Thanks for listening.
Don't forget to like, share, and subscribe for more.